Everyone, and welcome to today's webinar. My name is Sara, and it's a pleasure to have you all with us today. I have over 12 years of experience in the financial markets, and I have been helping individuals develop knowledge and skills related to trading during all these years. I'm certified from FINRA in USA, and as per the regulatory requirements of CMA, which is the Capital Markets Authority in UAE, as an investment manager. Welcome to Amana. So, Amana is a broker which has over 15 years of track record. It's one of the region's leading brokers, and it offers access to 5,500 or more financial instruments, both leveraged and unleveraged, across international and regional markets. That includes currencies, commodities, stock indices, ETFs, physical shares, etc. And that gives you a great deal of flexibility to diversify your portfolio and trade a wide range of global products. Amana is also regulated by different regulatory authorities, both local and international. Locally, we have DFSA and CMA's license, and internationally, we have SISEC, CMA Lebanon, and LFSA Mauritius. FSC Mauritius and LFSA Malaysian license. So today's topic is very interesting because normally I discuss topics which are more related to short-term trading, but today we will be discussing long-term portfolio building. And that brings us to a very important instrument called exchange traded funds, or ETFs. So before we begin, please take a look at this disclaimer on the screen and read this disclaimer. So if you want to get in touch with us, you can email us at support@amana.app, or you can call us, or you can get in touch with your relationship manager. And if you have any questions during the webinar, please drop them in the Q&A section below. So there's a Q&A section that you see below. Drop your questions there, and I or my colleague will try our best to answer them. So I will start now. So the first thing, when you even start about thinking to invest, is that before you invest, you have to build an emergency fund. And that is extremely important because there can be times of downturns in the market, or times when you are left with less than what you initially invested in the markets. And if you have invested your entire savings there at that time, you could be actually forced to sell during those market downturns and lock in those profits permanently just because you needed emergency cash. So, the first rule of thumb is that you need to keep about 3 to 6 months of living expenses in a very liquid, accessible account before you invest in anything. And this money should not be in equities. It belongs to a bank or a money market fund, and it's completely and easily withdrawable. So, and this is just not pessimism. It is just being practical, and it allows you to be a patient investor rather than to be a forced seller in times of market downturns when you might need money. The second thing is you have to clear high interest debt. So as we know that credit cards in the UAE will charge 2 to 3% per month, which is like 24 to 36% per annum. So if you are investing somewhere getting 10, 12, or even 15% per annum, this high interest debt is going to eat all of these returns or earnings. So the sensible thing to do is that please clear your high interest debt, which could be personal loans, car loans, or anything which has 8 to 10% annual rate should be cleared. When it comes to mortgages and low rate debt, that is not the priority here. I'm talking about high interest debt. The third thing is you need to actually understand and know your timeline. What that means is when you are investing, you have to invest in different products with different timelines. So there is money which you need within 2 years, which could go into cash or fixed deposits or money market instruments, but not things like equities. Then money which is needed within 5 years could go into a mix of low volatility assets like bonds or some equities. And money which you don't need for a long time, which is 5+ year, is where you invest in equities or equity ETFs or other growth assets. So, and this is very important because, the way that you allocate your portfolio over time really also determines your strength, how much you can hold the portfolio in times of downturns. So let me go ahead and now show you some very interesting numbers. So I have actually in this table, I have actually chosen some of the best and the most widely known investment vehicles. And these are all ETFs or exchange traded funds. Now, what is an ETF? I'm sure that most of you do know what it is. And for an exchange traded fund is an investment fund that holds a basket of assets such as stocks or bonds or commodities, and it is bought and sold on the stock exchange just like a regular stock. So an ETF is like a shopping basket, and instead of buying each item individually, you buy the entire basket. For example, an S&P 500 based ETF is going to have all the 500 companies in it represented by one share. So one share of an S&P 500 ETF will represent all the 500 companies. Similarly, we have ETFs for other indices like Nasdaq 100. We even have gold ETFs. So gold ETFs will give you exposure to the price of gold without you having to buy the physical gold itself. But you will be exposed to the price if there is any price appreciation. Your ETF will increase by similar value. So it is mirroring the price of gold. So here I have some instruments in front of me, and this table is actually going to show you that uh, if what was the cost of not investing in such a good diversified instrument. So I know that most people are afraid, especially beginners, and what they would do is they safely want to just put their money in a bank or buy some property or buy a bond and that's it. But when it comes to the stock markets, they're like, this is too risky, I'm not sure. So this is why I compiled this table just to show you that a typical UAE bank account could give you 1 to 2% adjusted for inflation, if not, yes, 4 or 5% as well. So some accounts are giving you 4 or 5% based on certain conditions. However, if we look at these instruments, for example, how the S&P 500 has performed. So in the past 5 years, it has given an average of 13.6%. And even if I go back in history, if I go back to 20 years and look at the average, the 20-year average is also very, very close to this figure. So what that means is that cumulatively, it has given around 90% in 5 years. And if you had a $10,000 invested in this, after 5 years, this is how much your investment would be. So all of these figures are, uh, you know, the base of these figures is the $10,000 and what it will look like after 5 years in a bank compared to that instrument. For gold, again, gold has had a huge bull run. I know that there had been, a time period of about 10 years when gold prices were stuck and they were, recovering. But in the past 5 years, definitely gold has given a huge annual return of around 17%. And the 5 year cumulative is 122%. So your $10,000, if invested 5 years ago in gold, we're looking at 22,200. And similarly, you can calculate for higher amounts. So the Nikkei 225, why I have put it here, because this is the Japanese stock market index, and you can have access to it on the Amana app. So if you go here, this is the Amana app, and if I write 225, yeah. So this is the Japanese index, and this is actually the future contract. This is not the spot index. So we will also have the spot. Yeah, it's JP 225. Okay. This is the spot index. So why have I mentioned it in the table? Because a lot of people don't know, but the Japanese market has actually outperformed the US market. And I'm talking about all these figures without leverage. So all of the figures that I'm telling you, they are unleveraged. And as you can see that for the past 12 years, the 1 year performance was 72% from Nikkei. So in the past 1 year, it has given 72%, and that has been because of due to some policies of the Japanese government due to them being becoming the leaders in semiconductors, as well as other factors such as a very low interest rate. And yeah, so even if we take into account yen's depreciation, even then you would be left with, over 50% return in US dollars. So again, it's a very good and a very interesting market to consider if you're thinking about investing. Okay. Again, 124% over 5 years, and your $10,000 would have become 22,400. NASDAQ 100, everybody knows that's the top 100 tech heavy US companies. It's the second most popular US index after S&P 500, and it's one of my favorites. It has definitely given more return than S&P because it's heavily weighted for tech. So as we know that the tech companies are actually giving the highest returns because of the AI boom and all that. So the Nasdaq 100 has, even though it's more volatile than S&P, it has given more returns. So yes, the dips are bigger, but the returns are also bigger. So 213% over 5 years, and this is what your investment would have looked like, 31,300. And then this is the last is an example of a single stock that I wanted to give, which is Nvidia, which was a very exceptional. And as you know that, it's, responsible for making the chips which are used in AI infrastructure. So it had this crazy return of 1,157, and your 10,000 would have looked like this much, which is a lot. So anyway, I am not really a big proponent of going and investing in single stocks because you never know that stock might actually not perform well. But I am a very big proponent of investing in ETF, equity ETFs, which are highly diversified, like S&P 500. Because through these, you are actually getting exposure to 500 companies together as a single basket. And for NASDAQ, you are getting exposure to the top 100 companies. Okay, so somebody has just asked me a question. Please explain a bit Sharia compliant side of this ETFs. I am not like very much aware about that, but I can get back to you. I have actually in gold, I know of one Sharia compliant ETF, but what are the ETFs which you can trade instead of this? I can just I or my team can get back to you about them. No, there definitely are ETFs which are Sharia compliant and based on these same companies. So now we move on to the different asset classes. So I'm going to quickly go over it. So the first thing is cash. As you all know, that's the foundation of every portfolio. It's the most liquid and the most safe. But the problem with it is that inflation erodes its value. So you can use cash as some emergency fund for your short-term needs, and but the return potential is low. It's just a safety asset. Next is your estate or rates. So real estate, as you know, is physical property. It's one of the most familiar investments in the UAE. Historically, in the UAE, property has done really well. It has become like a long term store of value. So, REITs offer property exposure without you having to actually buy an entire building, right? Physical property is illiquid. You cannot always find a buyer quickly. You will have to wait. Because of that reason, it is illiquid, and it does have a local sensitivity to the economic or to the business cycle, right? If you're investing there, you need to have long-term horizons. I know that a lot of people like to flip as well. They will buy off plan, give a certain down payment, and think that, we can flip quickly. But I have seen that a lot of times what happens is they also get stuck. So or the handover could be late. So usually what I've seen is properties are like they tend to gain value right before handover or at handover. So you might have a long period where you are stuck and you don't have a buyer. So that is one thing you need to keep in mind. However, it definitely is a very good investment, but this is not going to be the focus of my presentation. It's going to be, focused more on equity ETFs, gold, commodity ETFs, and bonds. So when we come to bonds and bond ETFs, so bonds are like single bonds which can belong to a government or it can belong to a company. They pay you a fixed interest rate or fixed coupon, and they have a maturity, and your money, your amount, your principal is returned at maturity. But bond prices slightly fluctuate because of interest rates. So the bond price is inversely related to the interest rate, right? When the interest rate rises, bond price can fall, and interest rate in that economy falls, the bond price can slightly rise. However, bonds are predictable because they have that fixed interest rate or fixed coupon. So people who want more predictability and fixed income will go tend to invest in bonds. Okay. One thing you just need to see is the credit rating of the bond, and there is some amount of credit risk. So the company who might be issuing might default. So those kind of things you have to check. Don't buy a bond which has a very high or a promised 10, 12, 14%, because that is actually, it could be a junk bond or it could be a low grade bond, which does have a higher possibility of default. So yeah, that is one thing. However, bonds will give you some diversification in your portfolio. Bond ETFs are like is a basket of different bonds. So these could be corporate bonds, these could be a mix of corporate and government bonds, or yeah, it could be both. So the thing with them is that the bond ETFs don't actually expire, and so the bond portfolio in the bond ETFs keeps changing. So what happens is that the ETF doesn't mature. It's a basket of bonds. So the new bonds keep coming, old bonds keep moving out of that basket, and there's no maturity date. But what is there is a fixed income or fixed contribution that you get every month. So the ETF is, for example, if the whole rate of return on the ETF is, let's say, 5%, right? So this 5%, like if you have $10,000 invested in the ETF, 5% is 500. So you're supposed to get $500 every year. 500 divided by 12 is what you will get from that ETF every month. And it's a fixed amount. So then we come to equity and equity ETFs, which I will go in more detail. So equity ETFs are things like index ETFs like S&P 500 or NASDAQ 100 ETFs, which are a basket containing top companies. And that can be like a broad index. It can cover many industries, or it can cover a particular industry, or it can cover mature companies, it can cover growth companies. So we have lots and lots of different types of equity ETFs. However, again, as I said, S&P 500 is the most well known and the most traded equity ETF. Okay. And then we have gold ETFs. So these are again ETFs which track the price of gold and allow you to get exposure to the price of gold without you actually owning the physical gold. So it's a good idea to have all of these things in your portfolio. Now, I just want to discuss one thing, that a lot of people like to buy single shares. So what they do is that they, they like to study different companies and the growth and earnings and this and that. And a few days back, people got excited about SpaceX, and there was a lot of speculation on the price and everything. So people do tend to invest in single stocks as well. But what I would suggest to you is that please, if you do, please keep that allocation quite low. It should not be more than 5 to 10% of your portfolio, because again, you are exposed to a single company. If that company fails, then your investment is wiped out. So it's not really a good idea to put a lot of money there. On the other hand, if you see an exchange traded fund, it's a basket which holds hundreds of companies, and as we know, it cannot actually get wiped out, right? So yes, there are going to be economic downturns, there will be dips, there will be times when you see your investment falling. But what history has shown us that the markets always recover. So S&P, whenever it has dipped, whether it was the dot-com, whether it was the global financial crisis, whether it was COVID, it has actually moved on to new highs. So this is what we have to understand. And the interesting thing is that indices like S&P 500 have a self-correcting or mechanism inside them. So what they do is they are built to self-select the companies which are the best performers in the market. So after every 3 months, the S&P constitution is reanalyzed, and any company which is not making it to the top 500 will be taken out, and any new company which is comes in the top 500 will be brought in. So in a way, you don't have to worry about which companies to select. It is the S&P, the way that that index is constructed, that by itself it will keep selecting the top 500 performers. So yes. So let's move on to dollar cost averaging. So when you are actually investing long term, and you're actually putting your money in all of these different asset classes that I talked about, how do you put the money? Do you put it as a lump sum, or do you put it in bits and pieces? So the concept of dollar cost averaging is that instead of putting all your money together, you put a little money every month, right? And what that the advantage of that is that you can actually end up buying fewer shares when prices are high. You can end up buying more shares when prices are low, and the price actually averages out over time. So you don't necessarily have to time the market, right? Some people think that timing the market is better. Let's wait for the dip. Once the market dips, then we will get in. But all the data shows that you cannot consistently time the market. That's impossible. You cannot consistently wait for a dip. You cannot consistently go in at the right time. That's really not possible if you're a long-term investor. So the better idea is you start small and you start investing. You start investing every month or every 2 months, a certain amount, and you keep adding it to your portfolio. And then over a period of time, your portfolio will build. And that is what dollar cost averaging is. So now, one more interesting thing. I was talking about the fact that a lot of people are afraid when it comes to investing in stocks. So they're not comfortable with it. They might take a bond, they might, invest in real estate, but then they don't feel comfortable. They think it's too risky. So I do want to talk about that what might be the possible risks of investing in a more risky asset, which is an equity ETF. So bond ETFs are not that risky, as we know, unless there is some risk, but apart from that, the bonds price fluctuation is quite less, and it's going to pay you a fixed return, right? Gold, as we know, yes, there are price fluctuations, and it can give you a good hedge against inflation and geopolitical risk. But then again, gold does not, historically, it has not offered the best returns. Yes, it has done really well in the past 4 or 5 years, but historically, it is stocks which have outperformed each and every asset class. So when an asset class is giving you the highest return, then obviously it also has risk. The higher the return, the higher the risk, right? So I want to look at the risks. So I've chosen COVID as an example because we all know the markets dipped, and there was panic, and the markets came down by around 30 to 33%. So here on the screen, you can see an investor who invested right before this crash. So he invested $10,000. And what actually happens is, sorry, there is a problem here. This is incorrect. This is actually 9,000, 8,000, 90. It's 98. Okay. So what happens is that $10,000 at the time of the COVID crash will approximately be equal to $6,600 in 1 month. And I'm talking about that crash which happened at the time of COVID, right? So if he had panicked, he would have sold everything here, right? But if he had not panicked and held on to the investment, we know that in 5 months, the S&P rebounded to a new high. So in 5 months, his investments would be sitting at $13,700. That's up from $10,000, right? So the idea with this is all a discussion around long-term investment and holding your portfolios, right? So the idea is the money that you put in these equity ETFs is not the money that you need immediately. And this is you're going in for the long term, right? So even if the market crashes, there is no need to panic, because again, history has showed us that no matter what type of crashes they were, eventually the markets recovered and then they made higher highs, right? And in my opinion, now the markets have the capacity to recover more quickly because of the AI digitalization, because of the way we trade, because of the policy instruments available to institutions. Things will probably not be like they were in the global financial crisis because the entire workings and the foundations of the financial markets have changed. And this was shown in this at the time of COVID. This was like an unprecedented event and there was extreme amount of uncertainty. Despite that, the markets recovered in just 5 months. And like I said, why did they recover so quickly as compared to the global financial crisis is because the nature of the markets has completely changed because of technology and digitalization. Things can now happen quickly. Policy instruments can be used very effectively and very quickly. We know there was a lot of money printing and quantitative easing and zero interest rates at that time. We know all that. But the what was the end point of it? What was the ending result of it? That the markets recovered. Yes, there was inflation and this and that, but the government made sure that they have to pull the market out of this, and they were successful. So again, the issue is don't get panicked and don't sell on bottoms if you're in this for the long term. Now, again, take a look at the risks. Any person who would have invested in S&P 500 right before COVID would have had to see a 34% fall in their investments, but within 5 months, yeah, so at the bottom, their $10,000 would look like 6,600, but after 5 months, they would turn into 13,700. Nasdaq 100 dropped by 28%, but then recovered in 6 months. Gold dropped by 15%, recovered under 5 months to this figure. And Nikkei again dropped by 33%. In 9 months, it recovered to this much, right? So this should give you a good idea of what to expect or behave or feel. I know that every negative event is different. It has different dynamics behind it. But again, this example is an extreme example. We do have market dips, and they could be maybe 3, 4, 5% or 10%. But I'm taking a more extreme example to show you that if something very unprecedented happens, this is how the markets tend to actually behave. So if anybody has any objection to this, please, you can write that in the Q&A. If if you agree with me or disagree with me, I would also like to know. Now, here I have actually made a sample allocation of a portfolio. So there is a hypothetical person, Leila, and she has a 15-year investment horizon. She's 34 years old. She's a salaried individual, and she has a capital of about $300,000 to invest with a medium risk appetite, and she can accept 20 to 30% downturns for long-term growth. Now, I'm just giving this example, and I know everybody has different starting portfolios, or they could have different time horizons as well, or they could have different risk tolerance levels as well. Okay, but this is just an example. So, what she does is she allocates 10% to emergency cash reserve, which is just some months of living expenses. But the problem is, again, she's not earning anything on the cash, it's just for emergency. Okay. 10% goes to fixed deposits, which is a short-term buffer, okay, which will give her something like a lower return than bonds or ETFs, okay? Then we've got 20% in bond ETFs, which is giving her a fixed income per month, which is balancing that equity risk and stabilizing the overall portfolio and balancing it. 10% is going to the gold because gold acts as an inflation and a geopolitical hedge. So again, the thing to understand is that gold is usually kept in your portfolio as a geopolitical hedge. Why? Because if there is a crisis, usually gold is seen to perform really well. So the equity portfolio can dip, right? Bonds might stay the way they are, okay? Depending on the interest rate, they might actually increase a bit in value, but it depends. However, gold in a time of crisis is going to make up for that dip that you have in other investments like real estate or like, shares. So this is why usually people will hold a certain part of their portfolio in gold, either physical gold or gold ETF. Then 50% is going to S&P equity ETFs or other ETFs, which are equity based. So why 50%? Because as we know that this market gives the highest returns. So this asset class is one which is actually giving the highest returns. So every individual, I understand, thinks differently, and maybe your idea of allocation can be quite different from hers. If you are more conservative, you could put less in equities, and perhaps more in some fixed deposit, giving you an interest rate, and maybe more in bonds, right? So I have a question here. Nikkei took 34 years to bounce back to the same level from 1990 to 2024. Okay. If I have time, I will answer this question. It's a good question. And if I have time, I will answer it. So just want to tell you guys one thing, that if you want to trade equity ETFs or any other ETFs with Amana, we have zero commissions on this. So you've got other brokers as well, which are the market leaders, but somewhere they do charge you some amount of commissions, even though if it's low. So, but with Amana, we charge completely zero commissions on these ETFs and regional stocks. And especially if you're doing dollar cost averaging, or if you are investing money into ETFs every now and then the commission cost can actually eat up your returns. So, yeah, that is a good thing to consider. Now I'm going to move on to the Amana app, and I'm going to be actually mentioning some very popular and well-known ETFs, which you can consider as part of your portfolio. Okay. So first of all, we have the S&P 500 ETF. So we have the most popular ETF for S&P, which tracks S&P 500, is SPY. So we have the SPY, and you can note this down. So this is the most S&P 500 ETF in the world in terms of liquidity and in terms of trading. It's very popular with institutions, with traders. So it is SPY. And then there is another one which is called WU. I'm sure a lot of you must already be knowing this. So this is the S&P 500 Vanguard ETF. So one thing that you have to see is the ETF might carry some leverage. So sign here, this lightning sign here means that it is leveraged. And how do you find out? I will just add this to my watch list. I will click on this and I will go down. And yes, I see the leverage factor, it's 2 to 1. So let me explain what that means. That means, for example, if that ETF has given me 20% annual, my actual return will be double. It will be not 20, it will be 40, because I have a leverage of 2 to 1. However, the risk is also twice. So this is something you have to consider. And I think that you can actually send us an email, and if you want the leverage removed, you want this to be like non-leveraged, I think we can do that. So just please check with us, send Amana an email, and if you don't want the leverage. Next, we move on to the NASDAQ 100 ETF. For NASDAQ 100, the best ETF is, so we have triple QM here. So triple QM is actually, one of the most well-known ETFs for NASDAQ 100. And then we move on to the gold ETFs. So for gold ETFs, we have Al Bilad Gold ETF, which is again, it's a good ETF because they have this particular, fund actually is holding physical gold reserves. And I think somebody asked me about Sharia compliant. So the Al Bilad Gold is Sharia compliant. Yeah. So most of these gold ETFs, what they're doing is they're holding the physical gold themselves, right? So there is, apart from this one, there is IAU, which is again IAU, the Gold Trust iShares. But this is leverage. I think it has a 2 to 1 leverage. Yeah, it has a 2 to 1 leverage. So if you want the leverage removed, you can email us and check if we can have it. But the Al Bilad one is not leveraged. And then we have the Another gold ETF is triple AU. So you can note this down. This is the Goldman Sachs physical gold ETF. Again, this ETF is also, I think, leveraged by 2 to 1. And yeah, it actually tracks the price of gold. So it's exactly tracking the price of gold. And as the price of gold rises or falls, the value of the ETF unit will also rise and fall accordingly. So then we have the bond ETFs. So for bond ETFs, we have the best one is BND, which is the US Total Bond Market Index. So this one, BND, is again, it's got thousands of government bonds, US government bonds, corporate bonds, and mortgage-backed securities. And this pays monthly distributions. So I think that the recent yield is around 5%, but that yield changes with, it changes a little bit with the market interest rates. So investors which are looking for a broad-based, bond ETF, this is like one good option. Okay. Then another one is government, GOBT. This is the US Treasury bond ETF. So this is only the US government or bonds or US Treasury bonds. And this also pays monthly distributions, and the yield is also, I think, 4 to 4.5%, slightly below the previous ETF, which was BND. And this is more safe because these are government bonds, and investors which actually prioritize safety and government-backed bonds over high yields can actually invest in this. So this is one the bond ETF that you can invest in. So again, if you have like, I will repeat this example. If you have like $10,000 and the bond is giving you 5%, that's 500, and that $500 of return will be divided over 12 months. Okay. Now I will come to this question. Somebody has asked me that Nikkei took 24 years to bounce back to the same level from 1990 to 2024. Okay. So Nikkei is what? It is the Japanese market index. Oh, I just had that in my watch list. Where is it? I think I didn't add it. It's here. Okay. So this is a fair point. You're absolutely right. But what I think that you need to actually see is, so there is one thing called a historical performance, right? Like if we look at S&P 500 over even the last century, we see that it has a very high and consistent performance of like roughly 9 to 10%, right? But Nikkei is different. It was not like that. So it is definitely a lot dependent on the Japanese government's own policies, and it is also a lot dependent on the interest rate. So the interest, sorry, on the interest rate as well. So there is an interest rate policy of the Japanese government, which is a very low interest rate, which means that there is a dynamic of carry trade which always exists. People want to borrow the Japanese yen because it is so cheap because of the low interest rate, and then buy from that money, invest that money in the assets or dollar denominated assets, right? So I completely agree that this market was not a good opportunity some time back. But what we have to see, we have to sometimes look at the way that markets are evolving and changing, right? So I just mentioned the fact as well that there was a long period of time where gold was also, in a downward phase, and then in a recovery phase. So if we look at gold, I don't know if I can go back so much. I don't think so. I can. No, not on this app. I can't. So this is the prices until 2023, right? But what I think needs to be considered is how the market has been behaving more currently, right? So when I trade and when I look at opportunities, I generally will give more weightage to prices which are closer. So I will give more weightage to the last 6 months or to the last 1 year as compared to the last 5 years, and more weightage to the 5 years as compared to the last 20 years, right? If we look at the global financial crisis, also it took a long time for the markets to come out. But then again, like I said, market dynamics have changed completely. What they were 20 years ago, they are not here now. Now, when I say Japanese index is a good opportunity. I don't mean dump all your money here, right? Let's suppose that you have a portfolio, right? So, first of all, analyze the market, try and understand what is causing this bull run, right? I did mention a few factors that they are coming out as leaders in the semiconductor business. Then a lot of big investors like Warren Buffett have actually increased their exposure to the Japanese market. And then the Japanese depreciation is also quite high. Because of that depreciation, the exports are cheaper in US dollars, which is actually facilitating Japanese exports, right? So take into account all of these factors and then decide if you feel comfortable, if you want to invest. If in your opinion or if in your mind, will this continue or could there be a disturbing factor which will bring this trend to an end, right? So when you're doing a portfolio allocation and let's say out of all the ETFs, you decided I will put maybe 25 or 30% in equities, right? In equity ETFs. Now, out of those 30%, you will put some amount in maybe, a broad-based US index, maybe some in, let's say, semiconductor ETF, which are getting very popular these days, right? Then you can put some money in maybe NASDAQ. So what you're doing is you are putting only a certain portion, if like let's say 5% or 10% in this market because you feel optimistic. Definitely, if you don't feel optimistic about it, or if you think you don't trust the Japanese government, there could be a sudden intervention, they could just kind of bring the interest rate because a lot of people feel that the Japanese government can intervene and it can actually because the yen has depreciated to levels that it did not for the last 40 years. So, like I said, it depends on your outlook. But what I do is I personally give more weightage to the more recent trend. So, for me, the fact that this index has been doing so well in the past 2 years is important, and also the way that I look at this market does give me confidence. What I can do is I can put 5% or 10% or whatever amount, that I feel comfortable. Again, diversification is very important. And you being convinced about a certain market is also important. So I hope that answers your question. Okay. Yeah. So for the 50% bonus, please can you send an email to support@amana.app. If you still haven't gotten that bonus for attending the webinar, you just need to send an email. So yeah, that's about it. So let's just summarize what we learned today. So we just learned that we have to establish our safety nets first. We need to have 3 or 6 months of emergency funds as cash or in fixed deposits close to us and available at all times. Then, when you invest, you can invest a little bit month by month or after a certain time period, which will actually lead to more returns in the long term as compared to you investing a lump sum amount together. Then you have to diversify your risk with ETF. So an ETF itself, by its very nature, is diversified, and then you can actually have more than one ETF. So you can have, gold ETF, you can have a bond or a bond ETF, depending. You can even have, a bond if you don't understand bond ETFs. Then you can have, in equity ETFs, you can have 2 or 3 ETFs. Like I hold an S&P, I hold investment in S&P ETFs as well as NASDAQ. So again, you need to be prepared for the fact that the market can dip, especially in equity ETFs. So you can see a dip for maybe 20, 30, or 40%, and you should be prepared for that, right? So yes. So thank you so much for attending the webinar, and I will see you next week. So next week, the topic is full trading plan, trading, how to place a trade from A to Z. And so see you next Tuesday. Thank you.